Here's what they're not telling you. In the last video, I told you silver could bounce from $74 because it was a support level due to a potential inverse head and shoulders pattern. I specifically said $74, not $72, not $71. And it bounced from there to $79 and is currently trading at $77. That wasn't a signal. That was tape reading education, looking for patterns, identifying levels, and letting price play out. I also told you we need to see proper displacement, a violent move with volume, to confirm the setup. That has not happened yet. Without that conviction, we treat this as range-bound price action, not a breakout. Now here's the new development the mainstream won't cover. Overnight, the SHFE, that's the Shanghai Futures Exchange, suspended 2 more account groups, bringing the total to 22 in just 1 week. That is not normal. That is intervention. And at the same time, the Shanghai premium exploded to $9 over the international price. OG John AG here. Now, if you're actually learning something here, if you're verifying the data and it's sharpening your view, comment OG John AG below. That's it. 2 words. Nah, 3 words. It tells me who's paying attention versus who's just scrolling. And if you're not following me on X, you're missing half the content. Real-time updates, data drops before they hit the channel, unfiltered takes, links in the description. Follow now. Current prices as I'm recording. Silver Western Spot $77, Futures $77. Shanghai Spot $86. Shanghai Futures $88. $9 premium, up from $7 last video. Gold Western Spot $49.67. That premium expansion from $6 to $7 to $9 while Western paper consolidates tells you physical demand in the East isn't backing down despite the manipulation. SHFE, Shanghai Futures Exchange, just suspended 2 more groups of accounts for trading violations. Total suspensions in just over 1 week, 22. 22 account groups suspended on a major global futures exchange in 7 days. The exchange did not like the manipulation of silver overnight futures Thursday, in coordination with U.S. traders. When you see enforcement action ramping up like this, that's the exchange saying the games being played are crossing lines even they won't tolerate. Check SHFE Article 16, Enforcement Disclosures. It's all documented, publicly accessible, verifiable. COMEX registered silver now down to approximately 93 million ounces after another 5 million yanked yesterday. Friday the 13th, vaults bleeding out. Is COMEX fighting for its life to stay solvent, or is this just another managed drawdown? March open interest sits at roughly 60,000 contracts after 6,000 rolled from March to May. That's 295 million ounces of paper claims against 93 million ounces of registered physical. Coverage ratio worse than 3 to 1. Did COMEX offer sweetheart deals to avoid standing for delivery? Desperate shorts buying time? 6,000 contracts rolling suggests pressure to push delivery obligations forward. But here's what matters. It's nowhere near enough. Curious how many longs yesterday's slam managed to shake out. Approximately 1,500 contracts. That's it. 6,000 drop in open interest for March futures, roughly 3,600 rolled into May, which is actually bullish positioning. 295 million ounce equivalent of silver open interest still left on March contracts versus 93 million registered at COMEX. Check CME open interest reports. Updated daily, specific contract month data publicly available. Here's the technical update for the short-term traders. In the last video, I said if $74 holds, we have the potential for an inverse head and shoulders pattern developing. Silver crashed to exactly $74, bounced, rallied to $79, currently at $77. That $74 level acted as support precisely as the technical structure suggested. But, and this is critical, we haven't seen violent displacement yet. We need base formation first, proper volume confirmation, and a clear break of resistance with follow-through before validating the bullish thesis. You don't catch falling knives, you wait for confluences to build. Now on top of that, we have a major macroeconomic catalyst hitting today. US CPI data drops this morning, and that will have a direct impact on silver prices. Inflation prints shape expectations for Fed policy, which drives the dollar and, by extension, precious metals. A hotter number could strengthen the dollar and pressure silver. A cooler print could reignite rate cut bets and fuel a rally. So we wait. We see how price reacts around the CPI release. We let the market show its hand before committing. That's not being indecisive. That's being disciplined. 150 exponential moving average on hourly chart is now at $81. That's resistance overhead. As long as price trades below 81, technical structure shows continued vulnerability to downside. If price reclaims 81 with conviction and volume, that shifts the entire technical setup. Until then, caution warranted for paper traders. This is tape reading education showing you key levels that matter for risk management. Now here's what the shakeout actually accomplished. Almost nothing. Banks managed to extract only approximately 2 million ounces of silver from SLV holders during the crash. That's confirmed by the roughly 2 million drop in SLV shares count reported. The wash trading on SLV during last session was off the charts, with overall only approximately 2 million shares net sold. Quite poor result for such an attempted shakeout. When you orchestrate massive price suppression and only extract 2 million ounces from the largest silver ETF, that tells you holders aren't panic selling. Check SLV shares outstanding data. It's reported daily, publicly accessible, verifiable through custodian disclosures. Funny how silver price can fall 11% without anyone actually selling anything. The lack of volume speaks volumes. This is exactly why people are standing for physical delivery at record rates. When price moves violently but volume is razor thin, that's not organic market action. That's algorithmic spoofing, coordinated suppression, paper manipulation without real physical changing hands. Liquidity is so thin now, it's very hard for banks to hide their trail when they execute these operations. Repeated instances of everything sell-offs over last 3 weeks. Equities, commodities, risk assets all hit together with falling yields. That's not healthy rotation. That's liquidity stress creeping in. Broader market internals weakening. This may be early phase, not the end. When you see coordinated liquidations across uncorrelated asset classes simultaneously, that signals underlying stress in the financial system itself. Margin calls, forced deleveraging, liquidity constraints hitting multiple markets at once. Here's the data point that changes everything about March delivery pressure. SHFE closes for Chinese holidays Sunday, reopens the 24th. They're closing with 353 tons of physical silver in their vaults, equivalent to approximately 11 million ounces. Total open interest at SHFE for February 26 and March 26 futures, approximately 360 tons of physical silver. That's essentially 1-to-1 coverage with zero buffer. By the look of it, COMEX breaks first. When Shanghai has barely enough physical to cover its own paper claims, that removes the arbitrage safety valve that previously could absorb COMEX delivery pressure. Shanghai Metals Exchange closes Sunday, February 15th through Monday, February 23rd. 8 days. I've been telling you this for 3 videos straight. Expect heavy manipulation in fraudulent paper markets during this window. Banks executing the playbook exactly as outlined. Use the calendar-based period when Eastern physical buyers disappear to maximize downside pressure without real absorption. The pattern is documented historically. Check price action during past Shanghai closures if you don't believe this is standard operating procedure. Now let me connect the geopolitical chess game mainstream media is deliberately misrepresenting. Bloomberg leaked a supposed Kremlin memo claiming Russia rushing back to US dollar under Trump. The reality is completely different. This internal document lists 7 possible areas of cooperation with US, but only after Ukraine peace and major sanctions relief. Using dollars in bilateral trade is one conditional suggestion to stabilize reserves and reduce volatility. This is brainstorming inside Kremlin, not official policy, not surrender. Russia's trade with China and India is now 90 to 95% in rubles, yuan, or local currencies since 2022 sanctions hit. BRICS internal trade reached 60 to 67% without dollars. Massive shield against Western financial pressure. Any dollar use with US would be narrow, temporary, fully conditional on compensation for frozen assets. Russia learned the hard way about over-reliance on weaponized dollar system. Repeating that mistake wholesale makes 0 sense when they've successfully built alternative payment infrastructure over 3 years. Here's what the Kremlin made very clear. If US lifts restrictions on dollar use, they will have to compete with alternative currencies increasingly being used in the world for settlements. Yuan will continue growing as international currency. Same applies to ruble and other currencies. The days of world reserve currency are over. There is no need to have one, and no nation with functioning brain would aspire to being world reserve currency going forward. China certainly doesn't want that burden. Connect this to why gold keeps rising despite these propaganda narratives. China's treasury holdings at lowest level since 2008. China urging banks to cut exposure as well. India reduced holdings too. Meanwhile, both accumulating gold, less paper, more metal. When largest foreign holders of US debt systematically reduce dollar exposure while accumulating physical gold, that's not temporary repositioning. That's structural shift in how global settlement works when trust in dollar system erodes. The rally in gold began 2022 exactly when US weaponized dollar against Russia. Central banks started moving from treasuries to gold for real safety. No major crisis has hit yet, no bank collapses, no forced huge QE programs. But analysts warn domestic debt problems and private equity stress will trigger it soon. New Fed Chair nominee Kevin Warsh wants lower interest rates to rebuild industry plus smaller balance sheet simultaneously. History proves that's impossible without printing more money. Reserve shortages already forced QE-style buying in December 2025. When domestic crisis arrives, new QE money stays trapped inside US, while gold becomes preferred global settlement asset. Russia's conditional exploration of dollar use under strict terms doesn't change this trajectory. It shows pragmatic flexibility, not retreat from de-dollarization. Unstoppable dollar weakness and coming crises set gold up for most explosive moves yet. Bearish case matters because you need both sides. Silver at 77 hasn't reclaimed 81 resistance. Could drop back towards 74 or lower if support breaks. Shanghai closed 8 days creates manipulation window we're in right now. Banks still have tools to suppress paper price through concentrated shorts, derivatives leverage, SLV arbitrage mechanisms. 6,000 contracts rolled from March to May shows delivery pressure can be postponed through contract management and cash settlement enforcement. 1,500 longs shaken out isn't massive capitulation, but it's still reduction in delivery demand. March 26th, contracts could roll further to avoid physical settlement. COMEX has contained these situations repeatedly throughout decades of documented manipulation. JP Morgan paid $920 million in September 2020, case number 1:19-CR-00438, admitted guilt, then returned to same desks executing same trades. Paper manipulation persisted before, can persist again. This is financial warfare education, not investment advice. Capital preservation first. The ones who survive volatility are positioned when real move comes. But here's the counter. Shanghai premium $9 and expanding. Physical and East commanding bigger premiums while Western paper consolidates. SHFE closing with 11 million ounces versus 360 tons open interest means essentially full allocation with zero buffer. COMEX, 93 million registered versus 295 million March claims. Only 1,500 contracts shaken out despite massive manipulation effort. Banks extracted only 2 million ounces from SLV during entire shakeout. 22 exchange account suspensions in 1 week. Silver bounced exactly from 74 as technical structure indicated. That's not coincidence. That's support holding where analysis suggested it would. When manipulation requires massive coordination, thin volume, everything sell-offs across asset classes just to extract 2 million ounces and shake out 1,500 contracts, that's not strength, that's desperation masked by volatility. Here's what matters now. Silver 77, 150 EMA resistance 81 overhead, 74 support underneath. Shanghai premium $9 expanding not contracting. COMEX 93 million registered bleeding out Friday 13th. March OI 295 million ounces versus coverage. SHFE suspended 22 accounts 1 week for manipulation. 6,000 rolled March to May, desperate shorts buying time. Only 1,500 longs shaken out. Banks extracted only 2 million SLV ounces. Shanghai closes today through 23rd, expect more manipulation. China dumping treasuries accumulating gold. Russia conditional dollar exploration doesn't change de-dollarization trend. Watch what happens during Shanghai closure next 8 days. Watch if 74 support holds or breaks. Watch if 81 resistance gets reclaimed with volume. Watch March delivery intentions leading to 27th. Watch Shanghai premium when markets reopen 24th. This isn't about prediction. This is about observation. Let the market prove itself. The ones who do that homework see manipulation failing to achieve objectives despite maximum effort. They understand why $9 premium matters when it keeps expanding. They recognize pattern when technical support holds exactly where analysis indicated, while fundamental pressure builds underneath paper suppression. Invest with logic, not hype. OG out and about.